This is the continuation of our July 3rd class presentation on federal taxes and how they pertain to property transactions and depreciation. So let's talk about some of the concepts of depreciation under tax law. The first concept we're going to talk about is accelerated cost recovery. Now, this is also referred to many times as ACR depreciation, again, accelerated cost recovery depreciation. And this type of depreciation pertains to property that was placed into service prior to 1987. And the concept of accelerated cost recovery is that it provides certain depreciation methods that allow an expense deduction, a depreciation expense deduction in excess of the current year's decline in the economic value utility of the property. Traditionally, in order to measure the decline in the utility, the economic value of a property, accountants have recognized depreciation in the year that the depreciation is associated with the revenue produced by that particular asset, and typically that was through straight line depreciation, where the cost basis of the asset minus its salvage value divided by the useful life gave us an equal amount of depreciation every year. Accelerated cost recovery is a bit different in that it allows for larger portions of depreciation to be deducted upfront in the beginning life of the asset than would be allowed under straight line depreciation. And the theory behind that is that would encourage businesses to invest more heavily in property to provide better employment, or to provide or to help maximize employment and productivity. Now, accelerated cost recovery assets, property that includes tangible property that is used in a trade or business for the production of income, and it has a determinable useful life. In other words, it's not an infinite life. There is some form of life associated with that asset. Within accelerated cost recovery is what we call asset depreciation range tables, or they're also referred to as ADR tables. And what these are is they're lists of acceptable useful lives, basically ranges of useful lives for different classes and types of assets. So if you're a business and you had a particular type of asset, you would locate the proper depreciation range within the table and determine, there's a certain range you could depreciate that asset within. Again, typically the useful lives were shorter than the normal useful lives of the assets, and that would help accelerate depreciation. Now, if we take a look at depreciation methods, accelerated cost recovery, straight line depreciation, and that's very simple: cost basis minus salvage value divided by useful life. And I've had students say, well, wait a minute, isn't that just normal depreciation? And the answer is yes, that's normal straight line depreciation. But again, remember that the asset depreciation range with the accelerated useful lives that you could utilize was actually what you'd get your the investment cost would be still recovered more quickly. It also allows for what we call a declining balance depreciation. That is the cost basis of the asset. Okay, now notice in this case, it's a cost basis of the asset, but no salvage value. So the cost basis of the asset times either 150% or 200% divided by the useful life of the asset. And this is generally allowable for property with useful lives that are basically equal to or greater than 3 years. Another method of depreciation is called units of production depreciation, and this is your cost basis of the asset minus its salvage value times the units produced that were produced during the year divided by the estimated total units that will be produced during the useful life of the asset. There's another concept called operating days depreciation, and it follows the same formula of units of production depreciation. Instead of production units of production, we talk about we would substitute operating days. The next item then would be income forecast depreciation, and this is a rather specialized type of depreciation, but it's the basis minus the salvage value of the asset times the income generated by the property during the year divided by the estimated total income to be produced over the useful life of the property. And this type of depreciation is limited to films, videos, recordings, copyrights, books, and patents. Also, the forecast needs to include all the income anticipated to be earned through at least the 10th year following the tax year in which the property was placed into service. As I mentioned, the accelerated cost recovery, or ACR depreciation, was for property placed into service prior to 1987. For property placed into service in 1987 and in future years, there's another form of depreciation. So ACR's ACR was replaced with another form of depreciation, and it's called Modified Asset Cost Recovery System, or you're also going to see it referred to as MACR's MACRS. And again, this is for property that was placed into service in 1987 thereafter. And MACR's recovery periods. MACRS allows for accelerated depreciation, and also depreciation is switched from the accelerated method to the straight line method when the straight line yields a higher periodic depreciation expense. So in this case, under MACRS, the maximum amount of depreciation is calculated and permitted every year. Salvage values for MACRS purposes are ignored. We use declining balance depreciation, and what we do is we use 150% declining balance, and that's used for 15 and 20 year property. 200% declining balance used for 3, 5, 7, and 10 year property. Now, MACRS does require straight line depreciation for residential property, and there's in this case, residential property again being real estate, 27.5 year recovery period. For non-residential property, the depreciation rate is straight line, 39 year recovery period. Now, MACRS also provides for accelerating the partial depreciation that may be taken during the first year of depreciating the asset. The first concept is what we call the mid-year convention. And mid-year means it's limited to personal property, and the property is treated as if it was placed into service at the midpoint of the year. So anytime you place property such as that into service, it's depreciated as if it was placed into service at the midpoint of the year. Also, mid-month convention is basically limited to real property. In that case, a property is treated as if it was placed into service at the midpoint of the month it was actually placed into service. There's also a special type of depreciation called mid-quarter convention, and this is used when the majority of personal property, and that's 40% of the property purchased during the year, is acquired in the last quarter of the year. The property in that case is treated as if it was placed into service at the midpoint of the quarter it was actually placed into service. And then depreciation is allocated based upon the period where the assets were acquired, 87.5% to the first quarter, 62.5% to the second quarter, 37.5% to the third quarter, and 12.5% to the last quarter. Now there is another feature in the MACC system that you may be asked a question or two about, and that is called the alternative depreciation system. The alternative depreciation system can also be referred to as ADS, and there are certain instances where certain types of property must use the alternative depreciation system, and this system, for all practical purposes, limits the amount of benefits that can be received from the MACC system. And it must be used for certain types of property, and it includes what we call listed property. And listed property means certain types of property that include, but they're not limited to, vehicles, computers, cell phones, if they're used for business no more than 50% of the time. And you're also going to see listed property coming up in some other areas regarding tax rules. So anyhow, it has to be used for listed property. It also has to be used for used, leased, or finance organizations, tangible property located outside of the U.S., and property imported from a country that engages in discriminatory trade practices. Probably the only area that you really have to remember is the area that it has to be used for listed property. And as I mentioned earlier, ADS is based upon straight line depreciation, generally with longer recovery periods than you'd get under MACC's depreciation. Now let's talk about gains or losses of a personal residence that comes up in the CPA exam. And this is kind of a set of learning slides here. In this case, gain on personal residence. If you're married filing jointly and you've owned your home for at least 2 of the last 5 years, and you lived in that home as your main home for at least 2 years, you can exclude up to $500,000 of gain, and that's a one-time gain. You can't, once you exercise it, you can't exercise it again. Or if you're married, if you're single, if you're married filing jointly, if you're single, the exclusion is $250,000. Now, the gain in excess of the exclusion must be included in your income, taxable income, even though the sales are, even if they're reinvested in another residence. Under the old tax laws, if you had a gain and you invested that in your in an additional or in your next residence, that amount would be deferred eventually until your home was eventually sold. That's no longer the case. And again, if you take a look at how you compute the gain, it's basically our net proceeds minus the basis in this case, the house, equals a net gain on the sale. That's subject to the exclusion of the gain up to $500,000 for married filing jointly, or $250,000 if you're single. If you have something in excess of that, that's a reportable gain that you're going to have to pay taxes on. And again, I've included the various items that would be included in net proceeds and the various items that would be included in the cost. I want to mention here, under the cost basis of the asset, you can include expenditures for improvements to your property, but not repairs to the property, and that equals the adjusted cost basis of your asset. Now let's try a slide regarding the sale of a personal residence. In June 2017, Dale and Mary sold their residence for $850,000. They incurred a sales commission of $50,000 on the residence. They owned and they live in their residence for over 10 years, and its original cost when they purchased it was $100,000. During the 10 years, the couple spent $20,000 to repair their existing roof and $40,000 for the addition of a room to the residence. So the question is, how much long-term capital gain will the taxpayers report on their 2017 tax return? Now again, go ahead, do your computations, make your selection. Stop the video before you do that, and then when you're ready with your computations, go ahead and restart the video. Okay, let's take a look at the answer. Number 11, in June 2017, Dale and Mary sold their residence for $850,000. They incurred a $50,000 sales commission on the residence. They owned and lived in the residence for over 10 years, and its original cost was $100,000. During the 10 years, the couple spent $20,000 for a new roof and $40,000 for an addition of one room. And how much long-term capital gain will they report on their 2017, that should be 2017, not 2016, 2017 tax return? The answer is B, $160,000, and it's computed as the selling price of the residence would be $850,000 minus the sales commission on the residence, $50,000, so the net selling price is $800,000. Now we have to figure out what is the cost of the adjusted cost basis of the residence. That's going to be our original cost plus the room that was added, $40,000. The repair and maintenance to the roof is not an addition to the cost basis of the home. So our basis in our residence is $140,000, meaning our net selling price was $800,000 minus the $140,000 basis in the residence, means that we realized a gain of $660,000. $500,000 of that gain can be excluded. I'm sorry, I skipped slides accidentally. $500,000 of that gain can be excluded, meaning that the amount of gain that we're going to have to recognize is $160,000. Okay, now let's go on and talk about, again, taxation of property and capital gains and losses. There are two principal requirements in order for capital gain or loss provisions to be applicable. Okay, number one, the item must either be a capital asset such as Dale's and Mary's home we just did in the previous slide, or it has to be property which is under what we call Section 1231. And under Section 1231, depreciable business property, real or depreciable business property held for over a year is considered, basically is treated like a capital asset. Remember, we talked about the fact that real or basically depreciable business property is not considered a capital asset, but Section 1231 says even though it's not a capital asset, it will be treated like a capital asset. Also, in order to have a gain or loss, there must be a sale or exchange of the asset itself. Now, we classify gains or losses in terms of short-term and long-term. Long-term is if the asset is held for more than 1 year and a day. Short-term if the asset is held for less than a year. So let's dive a little bit deeper into Section 1231 assets. Now, Section 1231 of the U.S. Revenue Code provides a basis for the tax treatment of gains and losses of, again, depreciable property and real property, buildings and equipment, used in a trade or business and held for more than 1 year and 1 day. Section 1231 allows a taxpayer to receive capital gains treatment, and generally that's going to be favorable tax rate if the taxpayer realizes a gain on Section 1231 property. And on the other hand, if the transaction results in a loss, we'll be able to claim the loss as an ordinary loss, a deduction from ordinary income on Section 1231 property. Now, you can have gains and losses on various types of Section 1231 property during the tax year. And if the taxpayer has a series of gains and losses on Section 1231 property during the tax year, the taxpayer must net all 1231 gains against all 1231 losses to arrive at a final net capital gain or loss. Okay, let's go on to one question regarding Section 1231 assets. Okay, let's try a question on Section 1231 assets. Again, this question says, select which of the following statements are true. And it says to qualify as a Section 1231 assets, and you're given 4 choices. You have to pick 2 out of the 4 choices. So again, stop your video, make your selection. When you're ready, restart your video. Okay, the answer to question number 13. To qualify as a Section 1231 asset, basically statements 1 and 4. The asset must be held for more than a year, and statement 4 must be used in a trade or business. Now, if we go over the different statements here, first one is for to be a Section 1231 assets, it has to be held for more than a year, 1 year and a day. B, Section 1231 assets are subject to Section 1245 depreciation recapture. We haven't gone over that yet, but Section 1231 assets, this is kind of a learning slide, Section 1231 assets are subject to what we call Section 1245 depreciation recapture. We will review that here in future slides. C, no, Section 1231 includes depreciable business property, which is not considered a capital asset if we go back to our original definition of capital assets. It includes depreciable business property for favorable tax treatment. And then D, that is basically must be used in a trade or business. That's part of the definition of a Section 1231 asset. In calculating a Section 1231 gain or loss, the calculation is relatively simple. If we go up to the top, the amount realized from the sale of a Section 1231 asset, and again, that includes, I've listed the proceeds of the sale, including assumption of the fair market value of property that's been transferred and so forth. Assumption of liability less the selling expenses equals the amount realized minus the adjusted cost basis is going to equal a Section 1231 gain or loss. Now here's where it gets a little bit tricky, because what we have to do is we have to apportion the gain or loss into two separate categories here. One that results in ordinary income and the other one that results in a Section 1231 capital gain or loss. Now let's talk about the portion of the gain that's attributable that results in ordinary income. This is because of Section 1245 of the IRS code that says under Section 1245, the portion of the gain that was attributed to depreciation has to be considered as ordinary income to avoid the not only being able to reduce your taxable income for depreciation, but also then allowing for the gain or loss benefit for a capital gain or loss. So you have to subtract out that portion and include that portion as regular income. Now what we're going to see here also is that there's another section of the IRS code, which is Section 1250, and that's for the recapture of depreciation related to real estate. For right now, our Section 1231 assets for our business property is included under Section 1245. So what we have to do is, based upon our Section 1231 gain or loss, we have to recapture that portion that was already taken in depreciation and include that part of the gain as ordinary income. And the remainder after the gain, the remainder of the gain after depreciation then would be then attributable to a Section 1231 capital gain or loss. Now let's take a look at how capital gains or losses, Section 1231 capital gains or losses, are treated. And here's a summary table, the treatment of Section 1231 capital gains and losses, and it's split into what we say non-corporations versus corporations. Under non-corporations, net short-term capital gain are taxed as ordinary income. So short-term capital gains are taxed as ordinary income, and that's for non-corporations. For corporation, net short-term and long-term capital gains are taxed as ordinary income. Okay, in the case of non-corporations, net long-term capital gain tax rates, depending upon what tax bracket you're in, can be 0%, 15%, or 20%. So there you can see the favorable capital gains tax treatment for Section 1231. Also for non-corporations, net long-term capital losses can be deducted, but they're limited to $3,000 per year, with the excess carried forward into future years. If you're a corporation, net capital losses cannot be offset against income. However, losses can be carried forward 5 years or backward 3 years to offset against any net long-term capital gains. And these are subject to, we'll talk about this, the Section 1231, what we call the 1231 look-back rule. Now this next slide is an example of a Section 1231 asset subject to a Section 1245 depreciation recapture. We have a company here that is called Case Company. It sold an asset for $600,000. The asset had been in service for 3 years, and $200,000 the asset cost had already been depreciated. The asset had an original cost of $600,000. Okay, now, if we take a look here, the original cost of the asset was $600,000, and we have depreciated $200,000 worth of the asset, so the accumulated depreciation would be $200,000. Therefore, we would have the adjusted basis of the asset is $400,000. In this case, we said the asset was sold for $600,000. And the adjusted basis of the asset was the $400,000. So there was a gain recognized on the sale of the asset of $200,000. But now we have to analyze the gain on that sale and split out the portion that was attributable to depreciation and the portion that was beyond the depreciation, to determine whether we have to recapture, or we are going to have to recapture, some of the gain under Section 1245 and determine if we have any type of Section 1231 capital gain or loss. So we take the gain of the sale of the asset, $200,000. Then the first thing we do is we have to then attribute $200,000 of that gain to Section 1245 depreciation recapture. And that $200,000 depreciation recapture is attributable to the accumulated depreciation that we've already taken our tax deduction for. Now that amount then will be reported as ordinary income, that portion of the gain. Now we compare that to any remainder of the gain on the sale on the asset in excess of the depreciation recapture. In this case, there is no additional amount because our depreciation recapture equals the amount of the gain on the sale of the asset. So in this case, there is no Section 1231 capital gain since all of the gain has been recaptured in depreciation. Let's assume right now that we sold the asset for $750,000. So our gain on sale of the asset would be not $200,000, but $350,000. The gain on the sale of the asset then would be $350,000. We subtract out our $200,000 depreciation recapture, and that means we would have $150,000 Section 1231 gain. So in that case, we would have out of a $350,000 gain, we would have a $200,000 Section 1245 depreciation recapture, which will be then recaptured as ordinary income. And then we would also have $150,000 Section 1231 capital gain, and that would be possibly subject to favorable tax treatment. In this next slide, I'm giving you an example again of a situation where case company ended up selling the asset for not only a gain, but they're also going to include a portion of the gain as a Section 1231 gain. Here we sold the asset for $660,000. The asset had been in service for 3 years, and $200,000 costs had been depreciated, and the asset had an original cost of $600,000. And if we take a look, the adjusted basis of our asset is $400,000 because we already claimed $200,000 worth of depreciation. Our asset sales price in this case is $660,000 minus the adjusted basis of our asset of $400,000 means in this case the gain that we recognize in the sale was $260,000. So the gain on the sale of asset is $260,000. We have to recognize $200,000 as a Section 1245 depreciation recapture, which is taxed as ordinary income. That's attributable to our previously taken depreciation. But then now we do have a remainder above the $200,000 depreciation recapture. The gain on our sale of the asset was $260,000 minus the $200,000 depreciation recapture means that we do now have a $60,000 Section 1231 gain. And again, that may be subject to favorable tax treatment. Okay, let's take a look at this example. Again, Section 1231 assets subject to Section 1245 recapture for an asset sale here. Again, here case company sold an asset for $350,000, and the asset had been in service for 3 years, and $200,000 of the asset cost had been depreciated. The asset had an original cost of $600,000. So again, we have the same adjusted basis of the asset of $400,000 like we did in the previous slide examples. The asset sales price, though, was $350,000. The adjusted basis of our asset is $400,000. So in this case, the loss recognized on the sale of the asset would be a $50,000 loss. And in this case, we would have a $50,000 Section 1231 loss. There'd be no depreciation recapture in this case since there was a loss. So now let's go on to a question or two about depreciation recapture. Othello Corporation sold machinery that had been used in business for $166,000 in the current tax year. The machine was acquired and placed into service in 2012. Original cost of the machine was $150,000. The amount of MACC's depreciation associated with the machine up to the date of sale was $88,000. So the question is what is the character of this particular gain? So you're given 4 choices. Go ahead and calculate your answer, stop your video, and when you're ready, restart your video. Okay, let's take a look at the answer to question, in this case, question number 14. Othello Corporation sold machinery that had been used in the business for $166,000 in the current year. The machine was acquired and placed into service in 2012, which tells us right away that it's going to be a capital, or it's been held more than a year. The original cost of the machine was $150,000. The amount of MACC's depreciation associated with the machine up to the date of sale was $88,000. The answer in this case would be basically the character of the gain. The character of the gain would be $88,000. The character of the gain would be an $88,000 Section 1245 recapture and $16,000 Section 1231 gain. Again, remember that Section 1245 requires a business to recapture the depreciation that has been taken on a Section 1231 asset, and it recaptures that as ordinary income. Any amount in excess of the 1245 recapture is a Section 1231 gain. So if we do the computation, the gain on the sale of the asset is $166,000 sales price minus the $62,000 net book value. That equals a gain of $104,000. So we take a $104,000 gain minus the $88,000 Section 1245 depreciation recapture, and that leaves us with the $16,000 Section 1231 gain, which corresponds to answer C. Now let's go and take a look at another area which we call the Section 1231 look-back rule. As we talked about in previous slides, or in the previous slide regarding Section 1231 gains and losses, the taxpayer must net all Section 1231 gains against all Section 1231 losses to determine if there is a net Section 1231 gain or loss for the year. Now, under these circumstances, a taxpayer may be tempted to use a certain type of tax avoidance strategy. And the best way to explain this is through an illustration. If we start off with tax year 0, let's assume that we sell all our Section 1231 assets at a loss. Okay, a loss on a Section 1231 asset can be deducted against ordinary income in that year. We go to tax year number 1. Then we can sell, let's say we sell all our Section 1231 assets, or all the assets that we can, at a gain that we need to sell. In that case, a gain on our Section 1231 assets can be or will be taxed at the capital gains rate. So you get 100% deduction against losses, against ordinary income, but gains are taxed at a favorable rate. So again, as I say here, using the above strategy, the taxpayer could sell assets will produce a loss in year 1 with the full loss deduction from ordinary income. In year 1, the taxpayer could sell all assets that would have Section 1231 assets that have a gain, and would have a gain, so the gain would be taxed at the favorable capital gains tax rate. So the look-back rule basically requires the taxpayer to recharacterize Section 1231 gains as ordinary income to the extent Section 1231 losses were claimed in the past 5 years. Now, let's see how this loss look-back rule works in the next slide. Okay, let's take a look at example 1. A taxpayer operates a proprietorship, and the taxpayer reported the following net Section 1231 gains since he begun business. And again, we're going to use example number 1 here. In year 1, we had Section 1231 losses of $65,000. Then in years 2 through year 6, we had no Section 1231 gains or losses. In year number 7, then, during the current year, there was a net Section 1231 gain of $75,000. In using the 5-year look-back rule, if we had any gains within those 5 years, we would have to, or if we had any losses claimed within those 5 years previously, we would have to net those losses against the gain. In this case, we had a loss in year 1 of $65,000, and that was deductible, fully deductible against ordinary income, being a proprietorship. And in year number 7, we would have the capital gains of $75,000. And in that case, that would be subject to favorable tax treatment. In this case, since there were no other losses that were claimed in the previous 5 years, that amount would be characterized as a $75,000 Section 1231 gain. So there's no recharacterization. But let's look at the same case where example number 2 with the same set of circumstances, but the difference in years there's a little bit difference in years. In year number 1, there was a $65,000 loss, so the taxpayer could take that entire loss and basically claim that against ordinary income. In year number 6, though, what happens is the taxpayer had a $75,000 Section 1231 gain, and again, normally the gain would be the taxpayer could go ahead and claim that $75,000 as a Section 1231 gain, receive favorable tax treatment. But with the 5-year look-back rule, what happens is that within the 5 years we would have to net any of our net tax losses against our gain and recharacterize that amount as regular income. So what we see here is basically $65,000, that net loss, the Section 1231 gain would be recharacterized as ordinary income as part of basically the look-back rule, and then the remaining portion, the Section 1231 gain in year number 7, would be remain as a Section 1231 gain. Okay, now let's take a look at a Section 1231 look-back rule computation question. Okay, let's take a look at this question on the Section 1231 look-back rule. Clip-On Corporation was formed in 2014, and the following represents their net Section 1231 activity in several years. 2014, there was a gain of $10,000. 2015, there was a loss of $15,000. In 2016, there was a loss of $20,000. In the current year, 2017, the company recorded Section 1231 gains of $50,000. As a result, what would be the character of the 2017 Section 1231 gains? And again, you're given 4 choices. Go ahead and analyze your choices. Stop the video. When you're ready, go ahead and restart your video to view the answer slide. Okay, number 15. Clip-On Corporation was formed in 2014, and you were given a set of net Section 1231 gains and losses. And in 2017, the company recorded a Section 1231 net gains of $50,000. As a result, what would be the character of the 2017 gain? And the answer in this case would be B, a net long-term capital gain of $15,000. Again, we have to use a look-back rule in computing capital gains. In theory, what could happen is that the entity could go ahead and take advantage of, if there was no look back rule, the entity could go ahead and avoid taxes by recording $50,000 to 1231 gains in 2017, which would be subject to, or could be subject to favorable capital gains treatment, while also claiming losses in previous years that would be fully tax deductible. So the look-back rule says net Section 1231 gains must be offset by the net Section 1231 losses from the 5 preceding tax years that have not been previously recaptured. So if we take a look at 2014, since there was a gain, there's no offset necessary. In 2015, there's a $15,000 loss. That's going to be offset against the gains in 2017. In 2016, there's a $20,000 loss, which is going to be offset against the 2017 gains. So the total offset of $35,000 of $15,000 and the $20,000 of the prior year loss carrybacks result in reducing that $50,000 net long-term capital gain to $15,000, and the other $35,000 would be characterized as ordinary income. Now let's talk about another depreciation recapture subject, and it's called Section 1250. You'll recall Section 1245 was a recapture of depreciation, a Section 1231 property, a recapture depreciation on Section 1231 property for personal property. Section 1250 is a recapture provision also, but this applies to real property. So depreciable real property, again, Section 1231 property, is subject to depreciation, but it's under Tax Code Section 1250. Okay, depreciation recapture is calculated based upon a statutory percentage applied to the lesser of the accumulated depreciation associated with the asset or the net gain on the sale of the asset. And the statutory rates are, for corporations, 20%, and for non-corporations, non-corporations are 25%. So now let's take a look at an example of this Section 1250 depreciable Section 1250 recapture in action. Okay, now let's assume a taxpayer sold a small building for $1,800,000. The taxpayer deducted $400,000 of depreciation expense over 5 years, and the original cost of the building was $1.5 million. So if we take a look to come up with the adjusted basis of our asset, the original cost of the asset was $1,500,000. We subtract out our accumulated depreciation for those 5 years, so the adjusted basis of the asset now is $1,100,000. We sold that asset for $1,800,000. We subtract out the adjusted basis of the asset we just calculated, and the gain recognized on the sale of the asset would be $700,000. So the question is how do we characterize the gain on the sale of the asset? So under the Section 1250 rule, let's go with non-corporations first. The recapture is the lesser of the accumulated depreciation or the gain on the sale. So the lesser would be the accumulated depreciation of $400,000, and our gain would be $700,000. So the accumulated depreciation is the lesser of. So it would be $400,000 times the statutory rate for non-corporations of 25%. That means $100,000 would be considered recaptured as ordinary incomes, and the remainder then would be a Section 1231 capital gain. So in this case, if we take a look here, the gain on the sale of the asset was $700,000. $100,000 then would be recaptured gain subject to ordinary income, and then the remainder would be a Section 1231 gain subject to capital gains tax treatment for non-corporations. Now, if we look at the corporation side, it's pretty much the same thing. The only difference is that instead of using the 25% statutory rate, the 20% rate is used for corporations. So in this case, the lesser of the gain versus accumulated depreciation is still $400,000, but now instead of that 25% being applied, we apply the statutory rate of 20%. So that means $80,000 is recaptured as ordinary income. So the gain on the sale of the asset is $700,000. We have a recaptured gain then, ordinary income of $80,000, and we end up with a net Section 1231 gain of $620,000. Okay, now we've been talking about the word netting quite a bit throughout this entire presentation. We're going to go quickly through a flow chart of how Section 1231 gains and losses flow through to either ordinary income or long-term capital gains. Okay, if we take a look, we start on the left-hand side of this slide. We show a Section 1231 gain, again, for 12 Section 31 property, a gain on 1231 property. The first thing we have to do is we have to apply our depreciation recapture. And again, those are recaptures under Section 1245 and Section 1250. Any depreciation that is recaptured is reported then as ordinary income or loss. The amount that was in excess of depreciation recapture is a net remaining Section 1231 gain. At that point. Now what we do is we combine any net Section 1231 gain with any net Section 1231 loss. If we end up with a net Section 1231 loss, that flows directly through to a deduction against ordinary income. If we have a net Section 1231 gain, what happens is the first thing we have to do is we have to go and we have to apply the 5-year look-back rule, which we have previously covered. And, beyond that then, anything that is basically survives the look-back rule becomes a long-term capital gain with potential favorable tax treatment. Okay, let's go on to a multiple choice question saying which of the following statements again, is not true regarding capital assets of a non-corporate taxpayer. And this is always one of those difficult questions where you have to be careful is that you have 3 statements that are true and 1 statement that is not true. And sometimes this requires a lot of very, very careful reading. So go ahead and carefully read the question and the statements, decide which one is not true. Don't forget to stop your video, and when you're ready, go on to the question or the answers to question number 16. The answer to question number 16, which of the following statements is not true regarding capital assets of a non-corporate taxpayer? And in this case, if a capital asset is sold at a gain on January the 20th, the asset would have to be acquired on or before January 20th to be considered a long-term capital gain. That is a statement that is not true. Basically, if a capital asset is sold at a gain on January 20, 2017, the asset would have to be acquired on or before January 19th to be considered a long-term capital gain. If we look about these other items that are actually true, if we take a look at item A, short-term capital gains are netted against long-term capital that are netted against short-term capital losses. And we can see where we're basically here, where we did in our formula, it does show that short-term capital gains and short-term losses are netted against each other. Then in item C, capital losses in excess of $3,000 may be deducted from IEJI up to a limit of $3,000 per year. That is true in that particular case. Deductions are limited to you can have a loss greater than $3,000 basically. And again, we're talking about a non-corporate taxpayer, so it would be under individual treatment, non-corporate treatment. And then anything, if you do have losses over and above that, they can be carried over and deduct against any long-term gains, or they can also be carried forward and deducted up to $3,000 a year. And then D, long-term capital gains are netted against long-term capital losses, and that is also true if we look down here where we have long-term gains minus long-term losses, ends up with net long-term gains or losses. Okay, let's go on now and talk about what we call special cost recovery provisions. And again, these are special types of depreciation. The two items we're going to talk about is Section 179 depreciation and bonus depreciation. Section 179 allows a taxpayer to expense up to $500,000, okay, of acquisitions of personal property in the year the asset was purchased, subject to a $2 million cap. And where our property is purchased, and we have property that is purchased in excess of $2 million, basically that excess amount will result in a dollar reduction of the deduction, Section 179 deduction. The taxpayer has the option under Section 179 to expense all or a portion of the qualifying personal property acquired. There's another type of special cost recovery provision, and it's called bonus depreciation. And in this case, a provision allows the taxpayer to deduct 50% of the cost of the asset purchased in its first year of operation. Now, the other thing we should remember is that this depreciation is not in terms of it's not extra depreciation, it's just depreciation of the cost of the asset moved up front. The property basis is reduced by both the Section 179 and bonus depreciation provisions, and the remaining basis then is depreciated for MACCs. Now what I'm going to do is show you an overall example of how three of these concepts, Section 179 bonus depreciation and MACCs, basically can be taken. Erie Retail purchased delivery trucks for $510,000. So there's our property, basically that qualifies under Section 179. So, and the total property acquired during the tax year overall was $2,100,000. Erie elects to take bonus depreciation and as much of Section 179 depreciation as they possibly can. So if we take a look at the total property basis purchased during the year, it was $2,100,000. The items that qualify under Section 179, sorry, I just switched. Okay, basically the Section 179 deduction, we can deduct up to $500,000 worth of eligible personal property. And in this case, here's our $500,000, but we do have to offset it because we purchased $2,100,000 worth of property, and anything above $2 million is a dollar for dollar offset. So what happens is we take our $500,000 maximum deduction for Section 179 and we subtract out our dollar for dollar offset of $100,000. So the eligible Section 179 depreciation for 2017 would be $400,000, and that would be added to our depreciation expense claim for 2017, $400,000. Now, in addition to that, we can also take bonus depreciation, which is 50% of our total assets. So in this case, we can take 50% of our total original cost of $2,100,000, and we can take 50% of that. So our bonus depreciation would be $1,050,000. So we could basically claim depreciation expense for bonus depreciation of $1,050,000. Now, what I mentioned is both our Section 179 and bonus depreciation. Basically, we have to offset against the cost basis of our property. So if we take the cost basis of our property of $2,100,000, subtract out our accumulated or our depreciation for $400,000 and $1,050,000, that means we have a net book value now equal to $650,000. Now, this remaining net book value can be subject to MACC's depreciation in 2017. Now, I'm using 5 years declining balance. In theory, mid-year convention, although to make life simpler here, I'm just ignoring our mid-year convention. But it would be the $650,000 remaining cost times 20% of that cost, which would mean I could also depreciate another $130,000 under MACC's during the year. I slip slides again. So my total depreciation expense would be equal to my $400,000 for bonus depreciation, or for Section 179, my $1,050,000 for bonus depreciation, and $130,000 for my MACC's depreciation, which would give me a maximum depreciation expense in 2017 of $1,580,000. And of course, that amount has to be subtracted from my cost basis of my property. So the remaining cost basis at the end of 2017 would be $520,000. Okay, let's take a look at our last slide, and this is a multiple choice question. It's regarding wash sales. Now, we haven't gone over wash sales before, so try your best in terms of what you think a wash. If you already know the answer, great. If you don't, try to figure out what the term wash sale means and see if you can discern the statement that is not true regarding a wash sale. Again, when you're, stop your slide, stop the video. When you're ready, go ahead and restart your video. Okay, the answer to question 18, which of the following statements is not true regarding wash sales? And the not true statement is, it occurs when a property or when a security is sold at a loss and the same security is repurchased within 60 days of the date of the sale. Then that's the item that is not true. And the items that are true is the loss associated with the sale of the security is disallowed. Loss on the sale of the securities can be added to the basis of the securities repurchased. That's also true. We'll see that in a few minutes. Loss is determined by the sales price of the security less the cost basis of the security. Now, the correct answer is it occurs when a security is sold at a loss and the same security is repurchased within 30 days of the date of the sale. And this helps deter the strategy of selling securities to first take a tax loss and then repurchase them again. Now, the characteristics that are associated with the wash sale is the taxpayer buys substantially the identical stock or securities. The taxpayer will acquire substantially this identical stock or securities in a fully taxable trade, which only makes sense. Or the stock or the taxpayer will acquire a contract or an option to buy substantially the identical stock or security in the future. Now, the consequences of a wash sale. Okay, the taxpayer is not allowed to claim the loss on the sale. In terms of the adjustment of cost basis, the disallowed loss is added to the basis of the replacement stock. So your cost basis is the cost of your stock plus your loss. In effect, it's basically deferring that loss into the future. Lastly, the holding period. The holding period for the replacement stock includes, if you're holding basically the stock, it includes not only the date the stock was purchased, but the holding period of the stock sold. We're talking about capital gains and losses. So with that, that is the end of question number 18 and the end of our presentation. Thank you so much for your time.